Welcome to your channel, Dr. Gazavi. Economics and financial issues are very important. Let's go.
Cryptocurrencies evoke polarizing responses from researchers and industry participants. Supporters claim that cryptocurrencies provide a store of value and are a game change in accounting practice. Opponents believe they are scams, prone to hacking and theft, and a financial bubble. A cryptocurrency has three characteristics. 1. It is a digital medium of exchange that uses strong cryptography to secure financial transactions. 2. Creation of additional currency units is controlled and not in the hands of any single entity. 3. Assets transfers can be verified. 1. Cryptocurrencies have evolved over the last decade. An anonymous person, Nakamoto, 2008, is the brain behind the first and the most popular cryptocurrency, BTC, popularly abbreviated as BTC. Other cryptocurrencies have emerged following the success of BTC, too. As of January 2022, a total of 8,700 cryptocurrencies with a combined market cap of $2.2 trillion are supporting $90 billion daily transactions. 3. BTC is the biggest cryptocurrency with a market capitalization, or currency in circulation, of United States dollar, USD, $888 billion and a market share of 40%. In comparison, $2.2 trillion of USD currency notes are in circulation. Cryptocurrencies are equal to the USD market. 4. Ethereum is second on the list, with a market capitalization of $443 billion. 5. The combined market cap of the top 6 cryptocurrencies is more than 72%, and that of the top 20 is more than 90% of the overall market cap. BTC's market cap is larger than the combined market cap of the next 25 cryptocurrencies. In a nutshell, the cryptocurrency market is large and heavily concentrated. The success of cryptocurrencies is attributed to the blockchain, the backbone of cryptocurrencies. There are 5 key features of blockchain. 1. Immutability. Since multiple copies of a blockchain are kept and managed by consensus across a peer-to-peer network, no one peer can alter past transactions. 2. Security. It is a fundamental cryptological law that is relatively easy to set a problem that is very, very difficult to solve. What is relatively easy for a network of computers to do is, in practice, impossible even for much larger networks to undo. 3. Verifiability. Anyone in the world can check for themselves that the rules of the system are being followed. 4. Resilience. The distributed nature of the ledger makes it resilient. Even if many peers go offline, the information is still accessible. 5. Transparency. All transactions are broadcast to all peers, making the ledger transparent. In addition to its original application in cryptocurrency, blockchain quickly became popular in other industries, including accounting. As a result, another concept, triple-entry accounting, re-emerged. Although double-entry accounting has been used for more than 600 years, blockchain has led to the emergence of a promising triple-entry accounting method. Triple-entry accounting with blockchain, when properly implemented, can fundamentally improve accounting. One of the main criticisms of cryptocurrencies is price volatility. As an example, BTC market capitalization grew rapidly from less than $1 billion in 2013 to more than $325 billion in December 2017, 218% annualized gain, collapsed to $56 billion in December 2018, 83% annualized loss, and recovered to $231 billion in June 2019, 1,602% annualized gain. 6. Such price volatility is not a characteristic of a major currency such as USD or GBP. As more publicly listed firms start accepting cryptocurrencies, the accounting profession has started focusing on the accounting standards of cryptocurrencies and suitable pro forma models, since cash is categorized as a financial asset under the International Financial Reporting Standards, IFRS. Do cryptocurrencies meet the definition of cash? There is no clear answer to this question currently. However, it is prudent to be ready for a positive answer, as many central banks contemplate currency-backed cryptocurrencies. Designed as a decentralized currency, BTC is not intended to become a reporting currency and instead complement fiat money. In the case of BTC, the accounting principle of faithful representation requires interpretation of the economic substance for financial reporting that varies with reporting entity. International Accounting Standards Board's IAS 32 specifies guidelines for financial instruments. The recognition, measurement and disclosure of financial instruments are the subjects of IFRS 9 or IAS 39 and IFRS 7, respectively. For a detailed overview of the IAS 32, refer to Deloitte, 2006, and IFRS, 2021. Many deficiencies exist in the IFRS accounting of cryptocurrencies compared with the traditional IFRS framework. There is no agreement about a specific accounting model for accounting for cryptocurrencies. The novelty, ambiguity, and the lack of official guidance surrounding cryptocurrency transactions impose additional audit risks that should be considered during client acceptance and retention and planning audit procedures. There is vast and rapid innovation taking place in the cryptocurrency markets. There are mainly 4 types of cryptocurrencies. Software Testing Help, 2022. Payment tokens are used for buying and selling goods and services on digital platforms without an intermediary, as in traditional finance and banking arenas. Of course, the majority of cryptocurrencies and tokens fall into this category. Examples of payment tokens: Monero, Ethereum and BTC. Utility tokens are considered coupons or vouchers, but essentially are digital units representing a value on the blockchain. In other words, the token provides certain access to a product or service run or operated by the token issuer. The holder gains the right to a product or service to an equivalent value of token but not ownership. Examples of utility tokens: Funfair, Basic Attention Token, BrickBlock, Timmycoin, Surin Labs Token and Golem. Security tokens are securitized cryptocurrencies that derive value from an external asset that can be traded under a financial regulation as security. They, therefore, are used for securitized tokenization of properties, bonds, stocks, real estates, property and other real-world currencies. Examples of security tokens: SIA Funds, BCAP, Blockchain Capital, and Science Blockchain. Exchange tokens are issued by and used in cryptocurrency exchanges, which are crypto marketplaces for buying, selling and swapping tokens. They are primarily used to facilitate exchange between other tokens or as gas utility payments. Examples of exchange tokens: Binance Coin or BNB token, Gemini USD, FTX Coin for FTX Exchange, OKB, OK Blockchain Foundation, for OKEx Exchange, KuCoin Token, Uni Token, HT for Huobi Exchange, Shushi, and Crypto.com Coin, CRO, for Crypto.com. The financial modeling and accounting of cryptocurrencies are yet to be fully explored. This paper attempts to contribute to the existing academic literature in 3 ways. Pro forma models for price forecasting. 5 established traditional econometric techniques, as opposed to novel methods, are deployed to forecast prices. These 5 methods, namely pooled ordinary least squares, OLS, regression, fixed effect model, FEM, random effect model, REM, panel vector error correction model, VECM, and generalized autoregressive conditional heteroscedasticity, GARCH, are workhorses of financial econometricians. Applying traditional financial econometric techniques, as opposed to novel methods, to an emerging cryptocurrency asset class makes it easy for other researchers and policymakers to compare results across traditional asset classes and cryptocurrencies. This paper focuses on three main areas of interest to financial pro forma modelers: returns, volatilities and linkages. These forecasting models can help finance and accounting professionals who deal with the IAS 32 standards. Cryptocurrency as a group. Instead of analyzing one currency at a time and running the risk of missing out on cross-sectional effects, as done by most other researchers, the top 6 cryptocurrencies that constitute 80% of the market are analyzed together as a group using panel data methods. By deploying panel data methods, well-established econometric techniques are applied to the cryptocurrency field. A major advantage of panel data is increased precision in estimation. This results from increased observations due to combining or pooling several data periods for each individual. Panel data research methods are frequently used in empirical accounting research. Cryptocurrencies as financial assets in a portfolio. More retail and institutional investors are adding cryptocurrencies to their existing portfolio basket with increasing popularity. The Public Company Accounting Oversight Board, PCAOB, lists digital assets as a key area of focus in its inspection outlook. Given the rapid public acceptance of cryptocurrencies, the PCAOB plans to increase its understanding of public accounting firms' client acceptance and continuance policies, resource deployment and planned audit procedures concerning cryptocurrency, PCAOB, 2018. So, it is essential to understand the linkages between cryptocurrencies and traditional portfolio characteristics. An efficient frontier is produced with and without cryptocurrencies to see how adding cryptocurrencies to an investment portfolio makes a difference. Pro forma factors influencing cryptocurrency returns. There have been several studies on cryptocurrencies' prices and returns. Many researchers found cryptocurrency returns hard to explain by commonly used economic or financial variables. Liu and Sievinsky, 2018, established that the risk-return trade-off of cryptocurrencies, BTC, Ripple and Ethereum, is distinct from stocks, currencies and precious metals. Cryptocurrencies have no exposure to the most common stock market and macroeconomic factors. They found that cryptocurrency returns can be predicted by factors specific to cryptocurrency markets, such as the momentum effect. Since their study was conducted in a non-panel setting, they did not account for cross-sectional effects across multiple currencies. Aalborg, Molnar, and De Vries, 2019, studied several financial variables and Google searches to conclude that none of the considered variables could predict BTC returns. Maladi, Diria, and Martinez, 2019, have studied BTC return predictability using stock markets and gold and accurately forecasted the direction of returns but missed the magnitude of returns. Branes and Mestel, 2018, observed that cryptocurrencies become less predictable, inefficient as liquidity increases. Some researchers have used technical analysis to explain cryptocurrency returns. Huang, and Ni, 2019, used big data and technical analysis and found that fundamentals hardly drive BTC returns. They constructed a classification tree-based model for return prediction using 124 technical indicators. They provided evidence that the proposed model had strong out-of-sample (OS) predictive power for narrow ranges of daily returns on BTC. Cryptocurrencies have very high unconditional volatility and are subject to sudden, massive price swings. As the search for determinants of cryptocurrency returns goes on, researchers have found broad themes, such as market forces of supply and demand, the arrival of additional information, trust, speculators, price clustering at round numbers, persistence, mining difficulty and block size, market stress and herding and investor attention. Instead of analyzing one currency at a time and running the risk of missing out on cross-sectional effects, as done by most other researchers, the top 6 cryptocurrencies that constitute 90% of the market are analyzed together using panel data methods in this study. Daily returns are analyzed using pooled OLS and panel data, random and fixed effects, methods. 2.2 Pro forma factors influencing cryptocurrency volatilities. Volatility possesses several stylized facts, which make it inherently more forecastable. As such, volatility prediction is one of the most important and, at the same time, more achievable goals for anyone allocating risk and participating in financial markets. ARCH and GARCH models have been applied to a wide range of time series analyses, but finance applications have been particularly successful. Financial market volatility is an important input for investment, option pricing and financial market regulation. Anderson, Boleslav, Christopherson, and Diebold, 2006, provide a comprehensive theoretical overview of volatility forecasting. The workhorse of financial volatility modeling is the autoregressive conditional heteroscedasticity (ARCH) family, initially conceptualized by Engel, 1982, and generalized as a GARCH by Boleslav, 1986. Engel's ARCH class of models spurred a virtual, arms race, to develop better procedures for modeling and forecasting time-varying financial market volatility. More than 135 GARCH models are documented in Boleslav, Watson, and Russell, 2010. Volatility forecasting in finance is a highly researched topic with detailed surveys. Since this paper aims to keep things simple so that most readers in the accounting and finance area can follow and compare results, a plain vanilla GARCH 1 model is used for volatility forecasting. In support of this rationale, after comparing 330 ARCH-type models in terms of their ability to describe the conditional variance, Hansen and Lundy, 2005, found no evidence that more sophisticated models outperform a GARCH 1. The GARCH 1 is the simplest and most robust family of volatility models. The GARCH 1 model forecasts both the direction and the magnitude of BTC volatility, and forecasting volatility is more precise than returns. 2.3 Linkages between cryptocurrencies and other financial assets. Many linkages exist between cryptocurrencies and other financial assets. BTC was originally termed digital gold, so researchers initially focused on links between cryptocurrencies, gold and national currencies. Dyerberg, 2016 classified BTC as something in between gold and the USD using GARCH models. Later on, the search for the linkages to other financial assets started. BTC is a hedge against the Financial Times Stock Exchange Index, Dyerberg, 2016b. BTC lowered portfolio risk because of its low correlation with financial assets involving gold, oil and equities. After studying 4 cryptocurrencies, Klein, Pham2, and Walther, 2018, found that gold and BTC behave in opposite ways. Gold acts as a safe haven asset in times of market distress. However, they show that BTC acts as the exact opposite and positively correlates with downward markets. Tawari, Adewuyi, Albalescu, and Wohar, 2020, provide evidence of significant risk contagion among major cryptocurrencies' price returns, both in bull and bear markets. Buri et al. 2017, showed that BTC could serve as an effective diversifier for most cases, using daily and weekly data and Engel's dynamic conditional correlation model, 2002. Dyerberg, 2016 found that BTC can be an ideal tool for risk-averse investors as a buffer against negative shocks to the market, whereas Dyerberg, 2016b, found that BTC can serve as a hedge against market-specific risk. Prior studies have not used panel-based econometrics to study linkages. Since cryptocurrency returns may be co-integrated, the panel-based VECM of Engel and Granger, 1987, and Johansson, 1991, is used in this study. Finally, Fama and French, 2015, five-factor analysis is used to uncover linkages between the stock market and cryptocurrency returns. Conclusions. One of the tasks of the financial econometrics profession is building pro forma models that meet accounting standards and satisfy auditors. This paper undertook such an activity by deploying traditional financial econometric methods and applying them to an emerging cryptocurrency asset class. Vast and rapid innovation is taking place in the cryptocurrency markets. More than 8,700 cryptocurrencies have been invented so far. Researchers need to understand such an emerging asset class. This paper attempts to create a bridge between the well-established econometric methods and an emerging cryptocurrency asset class. 6 major cryptocurrencies, BTC, Ethereum, XRP, Chainlink, Cardano or Litecoin, are analyzed. Collectively, they constitute more than 80% of the overall market. These 6 cryptocurrencies are analyzed in a panel data setting with the help of 6 econometric techniques: pooled OLS regression, the fixed effect model, the random effect model, VECM, GARCH and Fama French factor analysis. The main findings of this analysis are as follows. VECM produces the best out of sample price forecast of cryptocurrency prices. Cryptocurrencies are unlike cash for accounting purposes. The standard deviations of cryptocurrency daily returns are several times larger than those of other financial assets. Such high volatility does not support the argument put forward by some accountants that cryptocurrency is similar to cash. Cryptocurrencies are not a substitute for gold as a safe haven asset. The 5 most significant determinants of cryptocurrency daily returns are the Emerging Markets Stock Index, S&P 500 Stock Index, return on gold, volatility of daily returns and the VIX. Pro forma models need to consider these 5 factors, in addition to others. Their return volatility is persistent and can be forecasted using the GARCH model. In a portfolio setting, cryptocurrencies exhibit negative alpha, high beta, similarity with small and growth stocks and resemble firms with weak operating profitability. A cryptocurrency portfolio offers investors more choices and resembles a levered portfolio made of traditional asset classes. Future research on cryptocurrency returns, volatility and portfolios can include more asset classes, hedge funds, private equity, etc. and perpetual futures as factors and regime switching models. Besides, accounting standards, regulation, technology and central monetary policies can be incorporated on top of the econometric analysis.
Thank you for watching, and please subscribe to our channel. Economic and financial issues are very important. See you in the next video.